Last Friday, spot gold prices extended their recent weakness, failing to reverse the policy-driven downward trajectory, triggered by the newly appointed Federal Reserve Chair, Kevin Warsh. As Friday coincided with the U.S. June 19th federal holiday, domestic stock and bond spot markets were closed. Against a backdrop of relatively thin trading volumes, market volatility was amplified. Spot gold faced renewed selling pressure, sliding by over 1% during the session to ultimately close at $4,154.48 per ounce, marking a weekly decline of approximately 1.5% and recording its third consecutive week of losses. Although the prior peace agreement between the U.S. and Iran and the reopening of the Strait of Hormuz briefly lifted gold prices by pricing out geopolitical risk premiums, the exceptionally hawkish signals emitted during the Fed chair's debut press conference quickly reclaimed control of the market narrative. The updated dot plot revealed that more than half of the FOMC officials hinted at least one more interest rate hike later this year, with Warsh heavily emphasizing the stubbornness of current inflation. This development directly propelled the U.S. dollar index DXY to a near one-year high, closing in on the 100.40 threshold. A chief analyst at KCM Trade noted that the new chair's aggressive stance has entirely erased earlier optimistic expectations, allowing a dominant U.S. dollar to reclaim market leadership and exert substantive pressure on non-yielding bullion. From a tactical standpoint, analysts at Goldman Sachs pointed out in their latest report that gold is expected to maintain a cautious tone in the short term. However, they emphasized that the structural secular bull market thesis, predicated on gold as a long-term hedge against broader macroeconomic risks, remains completely intact. As normal market liquidity restores this week, investors are urged to keep a closed eye on the pivotal $4,100 defensive threshold. This content is for reference only and does not constitute investment advice. Trade at your own risk.